we move on to the next topic, which is treatment of surrender or cancellation principle. So, in the past 1 year, we have observed two main transactions that is happening in mostly unlisted and private companies, wherein they decide to cancel or the employees decide to surrender their options and the equity settled options, and the company decide to settle them or provide a liquidity to the employee in cash. This is mainly done for by private companies to provide an uh, exit to their vested option holder and provide liquidity to them. Uh, Coming to the disclosure over here, the disclosure bifurcates this type of transactions into two. One is the cancellation, wherein this states that if the options are already vested, in that case, the company have to reverse the impact through any other equity head, such as general reserve, and they cannot take the reversal impact in P&L. But if the options are unvested as on the cancellation date, then in that case, the company has to immediately recognize the remainder of the expense which was supposed to be recognized over the vesting period. So, as of, if if there are any unvested options which are getting cancelled, so as on the cancellation date, their entire expense, the entire remaining expense will be recognized as on that date immediately. The next part of this is the settlement. So if in case the cancelled or surrendered options, the company decide to settle them in cash, in that case, the company has to calculate how much amount, basically whatever amount of payment that they are making, if that amount is higher than the fair value of that equity instrument or share as on the date of cancellation or settlement, in that case, that additional amount needs to be recognized as an expense as on that date itself. Over here, one observation that we had over the past few years is that sometimes private companies tend to frequently opt for this type of treatment, wherein to provide an exit route to their employees, instead of issuing equity shares to the vested option holders, they cancel the options and settle them in cash. If these type of transactions happen quite frequently, then there a question arises whether to treat these policies or plans as equity settled or cash settled. Moving on to an illustration for this type of treatment for cancellation settlement, where we have laid out an example wherein 1,000 ESOPs were granted, equity settled ESOPs were granted to an employee as on 31st December 2024, which was supposed to vest 100% at the end of first year. Now, the option price of these ESOPs as on the date of grant was 100 rupees. So the total fair value comes out to be 1 lakh. But as on 31st March 2025 itself, but that is after 3 months itself, the company basically after that, the company decides to cancel and subsequently settle all these options at a premium of 10 rupees. So, as per the disclosure, as I said, the company, as you can see it from this example itself, the company is issuing, companies settling in cash at a higher rate than the share market value. So, if so, as the market value of the options, as on the settlement date, if it was, let's say, 500 rupees, the company is providing 510 rupees in cash settlement to the employees. So, there's an excess of 10 rupees per option that is being provided. So the company has to first reverse the total amount, first have to accelerate the total amount of expense, which is the 1 lakh rupees, as on the total expense need to be accelerated and recognized as on the cancellation settlement date itself, and then reverse to general reserve, and then additional expense, additional charge that needs to be recognized in P&L is that excess 10 rupees, which the company is providing as a premium. So 1 lakh rupees will be transferred and reversed to general reserve. The other 10,000 rupees will be charged as an additional P&L expense. Moving on to the next slide, we have provided you some general entries for this example itself. So the first general entry would be to recognize the complete expense, the complete 1 lakh rupees as on the date of cancellation settlement itself. So a profit and loss account debit to ESOP outstanding account credit, an entry would be proposed for 1 lakh rupees. The second would be to recognize the additional P&L expense arising due to the higher amount of payment that is being made, which would be profit and loss account debit to ESOP outstanding account credit 10,000. The third entry would be transferring the expense that has already been booked for the ESOPs from the ESOP outstanding account balance to general reserve account, uh, which would be the entire amount of 1,10,000 rupees. The last entry, the amount over here, there's some error, cosmetic error over here. The amount that will be transferred to general reserve would be 1 lakh rupees only, which was originally supposed to be recognized. The last transaction would be the amount payment that is being made, which would be 10,000 from ESOP outstanding account that has already been additionally recognized, 1 lakh rupees from general reserve account, which was transferred to general reserve account in the prior entry. And then the last entry would be to bank, that is the amount being paid to the employee, which would be the total amount would be 1,10,000. So this is an example of how the journal entry will move in case a cancellation plus settlement happens or during the vesting period of the options. Uh, Coming to lastly to the pitfalls and key considerations for these type of transactions. The first pitfall or risk is the increased expense recognition. So as I said, in case the vesting has not already happened, the company has to accelerate and recognize the entire expense as on the cancellation date itself. So this might lead to an impact in your P&L. So the company should assess whether the vesting should be accelerated and calculate the incremental expense that they have to recognize so that there is no surprise P&L impact. The second pitfall could be accounting complexity. That is, if there is any mistake in handling vested versus how the treatment of vested and unvested options will be moved, so will be done. So that could lead to an misstatement of expense or liability. So where the company has to ensure that separate accounting for vested and unvested options are done. For vested, in cancellation, the entire amount will be directly transferred to general reserve. For unvested, first any additional amount remaining needs to be recognized, and then that will be transferred to general reserve. The last risk or pitfall that could be there is cash flow impact. So since a settlement is being made in cash, and if the settlement is quite large, so that could put a strain on company's liquidity. So the company should take into consideration or model what cash outflow they will be seeing because of this settlement, and align the settlement timing with liquidity planning so that they don't face any liquidity issue in the future. Coming to key considerations, there are one of the main key consideration is the accelerated vesting. If any cancellation or settlement is happening, the unvested options are to be accelerated and allow for early exercise or repurchase. The second is expense recognition on premium buyback or settlement. If any premium is being paid on settlement, then that amount needs to be calculated and recognized as additional expense. The last key consideration could be the liquidity and share impact. As I stated earlier, uh, canceling and providing a cash outflow to the employees could have a significant liquidity impact to the company, so the company should take into consideration this. This was all for treatment of the transactions, that modification and surrender and cancellation. Coming to the market trend in volatility assumption. So in the last 1 year, we have seen that the auditors and companies are having a higher scrutiny on the volatility assumption adopted for the option pricing. So for this purpose, this is majorly for the unlisted companies, because listed companies have the liberty and advantage of analyzing their actual historical volatility for their own shares. But for unlisted companies, they don't have that luxury. So for them, what we did is we calculated the historical volatility for approximately 350 companies, which were listed before 31st March 2020 and fall in a market capitalization range of 2,000 crore to 10,000 crore. Why we have taken this market capitalization is because this analysis is mainly done for private and unlisted companies, and this is the range which usually newly listed and private companies fall into when they get listed. So for them, what we have done is we have analyzed what was the actual historical volatility over a term of 5 years, ending at 31st March 2025. What we found for those companies is that the actual historical volatility mostly falls in a range of 41% to 51%. So the average being 47%, as you can see in the chart, the majority of the companies have an historical volatility falling in this range itself, with the median being 46% and mean being 47%. Uh, Going on to the next slide, we have also divided this how basically how the historical volatility is. If you can see that more than basically almost 78% of the companies have a historical volatility of more than 40%, and mm, approximately 30% of the companies have historical volatility of more than 50%. So, and there are only a few companies that have a lower historical volatility, less than 40%, or and even few less than 5% companies have historical volatility less than 30%. So maybe because of the market fluctuations, all these type of companies tend to have a historical volatility in the range of 40 to 50%. Where one thing to note is that since these are companies with 2,000 to 10,000 market cap, crores market cap, the same cannot be said for more basically bigger companies such as NSE 50, Nifty 50 companies. Those companies tend to have a historical volatility in the range of 25 to 30%, but that is because they are more stable and have been listed for quite a lot of time. So the market has quite a lot of faith in those companies. That is why they have a lower historical volatility. But for a newly listed company or a private company, that is not the case. So they tend to have so over here the historical volatility or for the newly listed companies tend to be on a higher range, 40 to 50 or higher percentage. Over here, we have also provided a sectoral view for these companies itself, and you can see, as earlier stated, the volatility for all the sector lies in the range of 40 to 50% only. There are a few exceptions like telecom, which have a higher volatility of 54%. But these analyses are helpful for unlisted and newly listed companies because, as I said, they don't have luxury to analyze their own share for historical price. So what they have to rely on is companies that are listed in similar. If you can just move on to the next slide. Over here, what the coming to first talking about the accounting perspective over here, the accounting standard clearly states that for any unlisted or newly listed company, they have to take a reference of the listed peers or competitors which operate in similar business structure. If in case they don't, if in case they are in a niche market or a totally new market, in that case, they would still have to look at comparable companies which will operate in similar sector or a similar sector. So basically, any comparison to a listed entity is mandatory, and they have to do some analysis for such listed companies to come to a conclusion of what as a volatility assumptions to be taken. For listed entities, as I said, they have the luxury to determine the historical volatility of their own shares over the expected exercise term. Uh, to add, what we did is we analyzed volatility assumption adopted by a few. unlisted or private companies in the financial year 2024-25, what we observed is that the majority adopted a volatility assumption in the range of 40 to 50% only. So with only a few companies going up to 70% and a lower bound being in the range of 35 to 40%. The average of the volatility assumption adopted by unlisted and private companies was around 45% only. So over here, taking into consideration the listed comparables, and as we said as we saw in the previous slides as well, that even the newly listed companies have a historical volatility in the range of 40 to 50%. So this would be all for our market trend analysis for volatility assumption.